What is the deal with the Evergrande crisis in China? How can it impact the global and Indian market, and specifically my portfolio? SEBI Chairman Ajay Tyagi has issued a warning for the retail investors. We're going to look at all that, but today's main focus is on the top 3 holdings in my portfolio. I am invested in different sectors, but only 3 stocks make up 36% of my Indian stock portfolio. We are going to look at when I have bought those respective stocks, how those have performed over the years, and how much the stocks have grown to form the current allocation percentage in my portfolio. Welcome everyone, thank you for joining my show. Let's talk about the Evergrande crisis in China. Today we're going to see how deep the crisis is and if it poses any systematic risk that we should be concerned about. I feel that as an investor we should be aware of all this information and how it might impact our portfolios. The intent here is to really keep you informed so that you are prepared to handle these economic situations and adjust your portfolio accordingly. Also, we're going to see what a couple of super investors think about the impact of this crisis on global market. Evergrande Group is one of the biggest real estate developers in China. In fact, it is the second largest real estate developer in China, who took an enormous amount of debt over the years, but in recent years it has run into a lot of problems for which it cannot pay back its debt. As per the latest news, the Chinese government is not willing to bail out the company, so the company may go completely bankrupt. As of June 2021, they have above $360 billion of assets, which comprises of its finished and unfinished inventories and some investments including electric vehicle companies and theme park. Also, they have a total of around $300 of liabilities, which have been rapidly growing over the past few years. Along with aggressively taking on loans, they have been financing some of their property developments through pre-sales from the customers. In August 2020, the Chinese government decided to regulate the real estate industry and crack down on taking on leverage. As a result, Evergrande was not able to take any more new debt. So without the new money from the new debts, they could not build more properties as they almost ran out of money. But still they have to pay the interest on the bonds, right? One of those bond interest payments of $83 million was due on September 23. Yes, that was last Thursday. Though the company has a 30 days grace period to pay the interest, if they fail, they will technically default on the payment. They have another coupon payment next Wednesday, and for the rest of the year, Evergrande has interest payments due each month in October, November, and December. So there is a great possibility that the company might go bankrupt. But why do we bother? Why do we care if a real estate company in China goes bankrupt? Surely for China it can lead to an economic disaster which would impact a lot of stakeholders. The company has 1.5 million deposits for buildings which they are yet to deliver. If they cannot borrow from the lenders, they do not have liquidity to develop more properties for the customers. In these situations, the customers have already paid the money, but they are not in possession of their properties. They also operate a financial service firm that may not be able to give the people's money back as the money has already been used for property development. Surely the real estate market will take a hit as Evergrande is selling the properties or assets at a lower price to meet the bond interest payments. It will definitely impact and depress the prices in the overall real estate market. As real estate contributes to 29% of China's overall GDP, it will have a wider impact for the economy. It will finally hit the financial sector, and all the institutions who have lent money will take a big hit. This brings the question, can this situation lead to a global economic disaster? Now, some people are comparing this crisis with the collapse of Lehman Brothers in 2008, in the United States, which of course kicked off the global financial crisis. Let's see what is the legendary investor Ray Dalio's opinion on this.
Beautiful. I want to get this on the record, though, Ray Dalio, because every Wall Street firm is saying this morning this is not a Lehman moment. What we witnessed yesterday in the lesson in price. Explain why this is not a Lehman moment to Ray Dalio.
Well, because a Lehman moment produced pervasive structural damage through the system that wasn't rectified until the Treasury came across in terms of its borrowing, and then the Fed came across with quantitative easing. But this is not that kind of a shake-up type of thing. This is $300 billion is what they owe, and this is all manageable. The basic economics is for all countries in all time is that if your debt is in your own currency, you can deal with it.
You can work it out.
You could work it out. We've seen it happen over and over again, and it's a good thing that lenders get stung or that the borrowers get stung. That's how the system works.
On the domestic front in India, legendary banker Uday Kotak has compared this situation with the 2018 IL&FS crisis in India. Now, only time will tell how this issue is going to impact the Indian economy in the long run. But as the news broke on September 21st, we could see some sell-off in the Indian market. But it readily bounced back on the very next day, and Sensex crossed 60,000 mark on Friday for the first time in Indian history. In this environment, let's see how my portfolio has performed this week. Though the portfolio went down on September 21st along with the market, but overall it has gained 8,214 rupees in the last week. Moreover, I have invested about 8,000 rupees in our stock, so currently it's worth 8,32,000 rupees. Moving on, SEBI Chairman Ajay Tyagi has cautioned the retail investors on the craziness in the IPO market. He said that the IPO market price discovery is not as transparent or efficient as the secondary market price discovery. And he advised the retail investors to focus more on the secondary market only because the disclosures for already listed companies are available much more. Funds raised via IPOs in FY22 till date are almost equals to what was raised in FY 2021, which was 46,000 crore rupees, the SEBI chairman said. And an additional 25 to 30 companies are expected to come out with IPOs in the remaining months of 2021. As per the data compiled by JST Investments, companies are not so much raising money for expansion, but for providing an exit to early shareholders. But this does not boost companies' future prospect, isn't it? Meanwhile, Ashwath Damodaran, who is one of the finest minds globally on valuation and markets, believes that many IPOs like Zomato, Paytm, Delivery, Nykaa, or Flipkart want to go public because the mood is right. But at the same time, they are not designed to be healthy and successful businesses even in the long term. So it's not at all encouraging for a long-term investor like me. This is the first time I am revealing the top 3 stocks in my portfolio. At number 3, there is none other than HDFC Bank. Only surprise can be that it only has an 8% allocation in my portfolio. I have been accumulating this stock throughout this year in a very systematic way, and I will continue to buy HDFC Bank as I believe that this stock is currently undervalued around 10 to 15% to fairly valued. In this current market situation, finding a stock of HDFC Bank's quality and growth prospect at this valuation seems very, very lucrative to me. Hence, I will continue buying this stock till its allocation hits around 12 to 13%. As part of my systematic approach, this month I have bought 5 units of HDFC Bank, and as of today, my HDFC Bank holdings are worth 67,265 rupees. I do not want to go for fundamental analysis of my stocks on this show, but I would like to show you some insights shared by Marcellus PMS on HDFC Bank. In this newsletter, Marcellus has highlighted how HDFC Bank continuously increased their profit growth despite various market sentiments at various times. So they have analyzed how was the narrative of the stock at a certain time and how the business performed subsequently. In November 2016, the narrative was that demonetization will lead to high NPAs and India's GDP growth will come off. Credit growth in the country will be subdued for the next couple of years. But actually what happened was that HDFC Bank delivered 15% year-over-year PAT growth during the quarter ended December 2016 and 18% during the quarter ended March 2017. In September 2018, the narrative was that ILFS entities have defaulted on their borrowings, and this is a systematic risk. HDFC Bank, being one of the largest banks, will have some exposure to entities related to ILFS. But in reality, HDFC Bank reported 31% year-over-year PAT growth in September 2018 quarter. Similarly, in March 2020, after the first wave of COVID struck, the narration was that HDFC Bank has the largest portfolio of unsecured loans amongst the large banks, and it might lead to a severe deterioration in asset quality. But in the quarter ending March 2021, HDFC Bank delivered 16% year-over-year PAT growth after making upfront COVID provisions. And more recently, despite the COVID second wave and RBI credit card ban, in the quarter ended June 2021, HDFC Bank delivered 14% year-over-year PAT growth after making further provisions for the second COVID wave. This chart perfectly reflects the above analysis. Even though the narrative kept on changing, HDFC Bank continuously grew their profit every year and delivered a profit after tax CAGR of 20% from financial year 16 to financial year 20. In this chart, quarterly PAT is denoted by the blue bars and share price is denoted by the orange line. As the profit after tax kept on growing almost every quarter, the share price also followed, and share price also grew at a CAGR of 20%. I do not see why HDFC Bank cannot continue the same growth for the next 5 to 10 years while taking the market share from the PSU banks. I'll be sharing the link for this article for your reference in the description below. The second largest holding in my portfolio is Bajaj Finance. It currently has an allocation of 14.04% in my portfolio. I started buying this stock right before the COVID hit in 2020. And if you see my transactions, I continued buying Bajaj Finance even when the market dipped about 35% during the COVID crash in 2020. The stock price was lowest at around May 2020, and I continued my systematic buying till September 2020. And currently I hold 15 units of Bajaj Finance, which is worth 1,16,901 rupees. Again, let's check out an analysis on Bajaj Finance shared by Marcellus PMS. This article explains how Bajaj Finance is transforming its business model to dominate the market in the next 5 to 10 years. I think this chart beautifully shows how BF has managed its NPA while consistently increasing its assets under management and profit before tax since the financial crisis in 2008. The green line denotes net NPA, the red line denotes PBT, and the sky blue bars denote asset under management. Since 2008, the NPA has come down from 7.1% to 0.8%, while PBT has grown to 5,992 crores. The way they're planning to transform their business over the next few years, it makes me super excited about holding Bajaj Finance. While I'm currently not buying Bajaj Finance anymore, if the price comes down, I will surely pick up some more units. Finally, the largest holding in my portfolio is consumer durable company Bajaj Electricals with an allocation of 14.14%. It's again a part of Bajaj Group, and the business is spread across consumer products, illumination, and power transmission and distribution. It sells a variety of consumer products in different segments such as home comfort and essentials, food preparations, and cooking essentials as well. As part of the illumination business, they develop indoor, outdoor, and solar solutions, and they also have some projects related to power transmission and distribution. These are the transactions I made for Bajaj Electricals. I made only 2 buy transactions, one in February 2017 and another in August 2017. Total of 80 units worth 22,000 rupees, and I have been holding the stock since then. My average price is about 276 per share and currently is trading at 1471 rupees per unit. So this stock has given me more than 5x return till now. This is the magic of long-term investing. As of now, I am not planning to buy this stock at the current price anymore. As long as the business is doing well, I'm just going to hold it. There you go. These were my top 3 holdings. If you do not already know, this show is centered around my Indian stock portfolio. And like today, I'll be gradually revealing my portfolio and provide you an update on a regular basis. You'd be able to follow my portfolio performance during all market situations, be it a bull market or a bear market. Along with that, I share economic updates on India and the global market and various super investors' thought on various topics of investing. I feel that this content can be educational and inspiring for many of the viewers. If you like this kind of content and want to follow how I build my portfolio and track its performance benchmarked against BSE 100 index, please be sure to hit the like button and consider subscribing to my channel. I hope you enjoyed this episode. Have a great week ahead.